As an investment company, the accounting numbers rarely reflect the true performance of our business. The way we look at our business is two measures. One is increasing cash from our businesses, which we use to pay higher dividends every year, and the other one is obviously capital growth. So the main one to take out of that is the ordinary dividends and interest that we received for the half was up 25% on the prior period. We wouldn't expect that growth to continue. We're starting to see the downturn in the commodity cycle impacting us from New Hope, and that'll start biting over the next couple of years. But thankfully, the benefits of our diversified portfolio is showing through with some very significant increase in contributions from TPG, Brickworks and API, all up over 30%. This is the snapshot of the portfolio, which I'd say is the best way of analysing our portfolio. It's showing that the strategic investments, which make up about 82% of our portfolio, were up 1% for the half, which doesn't sound very impressive, but the All Ords was down 11% for that same period. That's on top of about a 17% outperformance in the FY15 year. So the portfolio continues to capitally improve, as well as our increased dividends. Of the 18%, which is not in our strategic portfolio, the sort of below the middle bar there, the overwhelming proportion of those investments are in listed equities, your sort of ASX 100 blue chip type stock, which we invest for yield. We're underinvested in cash at the moment because you can get better yield out of the market. But we still see that as our opportunity sort of fund. We could liquidate that portfolio in a matter of days if we find the right thing. So we're very actively looking for new investments to add to our strategic portfolio, and we'll be looking outside our current portfolio, but also some of those listed and unlisted companies below the line. It's almost like our incubation fund. So we'll also look in-house for our next opportunity. As I mentioned, the dividends are up. The share price has performed very strongly over the last 12 months, so it's been 34% TSR, which is a massive outperformance against the index. But more impressive for us and more relevant to us is the long-term performance. And you can see that at over 15 years, it's almost been double the index. The impact of that is that an investor 15 years ago in Sols has done 6.2 times their money versus the index of under 2 times. Increased dividends. The dividend for the half was up 5%. Sols is one of only 2 companies now that in the last 15 years has continually increased dividends. The other one's Ramsay, and Woolworths was there but just dropped off. So you can see that through the cycle it's been a very impressive history of paying increased dividends. The last thing I'll touch on, I think people are aware of the tremendous growth of TPG, and we still see that as being one of our growth assets in our portfolio, notwithstanding it's one of our largest investments. But I'll touch on the acquisition of Bengala, which I think we announced last time we were here 6 months ago. We settled on that the 1st of this month and take possession, 1st of March. The thesis around that still remains that we're very confident on long-term coal prices. Last year I put out the global demand for energy doubling in the next 20 years. Coal's share of that pie remaining steady at around about 36 to 38%. This graph here from Wood Mackenzie showing that the growth in that demand is primarily coming out of Asia, who are the strongest markets for coal. They're price sensitive. It's close to our region. Coal is still about half the price of gas energy in Asia, and we'll see another leg down with the Japanese fiscal contract year kicking in the next few weeks, and it'll be about $7 or $8 lower than the previous year. But I'm hopeful that that's the last leg down, and we'll start seeing a recovery in coal.